Welcome to another amazing episode of the Plan Your Federal Retirement podcast. I'm your co-host, Micah Shilanski, and today I have a very special guest joining me to talk about, well, one of my favorite topics, Steven Jarvis, CPA. Steven, thanks for joining me, bud.
Well, I'm glad to be here, Micah. Does that mean that I'm your favorite topic? You left out what the topic is.
Well, I was trying to be a little bit of saying, ooh, they got to stay tuned. No, you are not my favorite topic.
Oh, okay,
so sorry about that. Nor CPA is my favorite topic either. I know I'm just losing credibility all of a sudden. But taxes, CPA
yes,
taxes, there we go. So as my audience knows, man, I love just chit-chatting about taxes, which is absolutely fantastic because, Steven, at least in my opinion, I know you specialize in this as well. You work with you work at advisors, number one, and you work with advisors and really helping them work with their clients, specializing in tax planning for retirees. Is that right?
That is correct. Yeah. We named our firm Retirement Tax Services. We just want to take all the mystery out of it.
That's right. Be really clear. Now, for our audience as well, you should know this is always holding it up right here. Don't get killed in taxes. And Steven, one of the things that I like about this, and this is a taxpayer facing book. It's not an advisor book. It's not a tax geek book. As much as I do love jumping into those, I do love the fact that when you guys wrote this book, you and PJ Denuzio, you focused on what are the strategies we as advisors use, you as a tax preparer use to help clients reduce their taxes over the long term and help kind of demystify it and kind of walking through these things. And there's really important stuff that it's so easy to overlook when we're doing tax planning.
Yeah, a lot of the thought process behind the book was, okay, there's hundreds of millions of Americans that are required to pay taxes every year, but when were they ever taught how any of that works? And so it's meant, if you pay taxes, the book is meant for you. And we go through, to your point of demystifying things, we go through and talk about some common myths that people believe on taxes, and then give just some real basic building blocks. This isn't reciting the tax code or giving anyone a PhD. This is helping you understand what it is that you have to do every year. And then to your point, we go through 20 different strategies that are pretty common for people either planning for retirement or in retirement, that not all of them are going to be relevant. But again, it's meant for the person paying taxes to understand, oh, here's why this is important.
I just love it. Yeah, so not here to push his book, just that is a highlight that he has done. He's put a lot of great effort into that. I know I appreciate it. So Steven, thanks for putting the energy into that.
Yeah,
of course. Steven, today we wanted to get together and we wanted to talk about the Secure Act 2.0. Now, before you tune out to the podcast, we promise we won't go, I will try. Steven will have to hold me back from going too tax geeky on this. But there's some important things that affect us, not only as taxpayers, as potential retirees, but as federal employees. And so these are things that I wanted to make sure we had a chance to kind of address. And there's still some unknowns, right? And sometimes, Steven, I get the impression when I'm talking to clients is that we're like, hey, the law's passed. Now we know what's happened. And boy, man, we would love that. But the reality is the law gets passed by Congress and it creates a bunch of confusion. And generally you have the tax industry, financial planner, CPA saying, all right, we think it means this. Then the IRS at some time in the unknown future comes back and says, nope, it actually means this. And then we got to scramble a little bit. So we have had some clarification on things, which is great. So I would love to talk a little bit about that. I'd love to talk a little bit about kind of overall the Secure Act 2.0, how it affects, what are things we got to be thinking about taxes, and get into some tax planning, some action items. Steven, does that sound fun to you?
Sounds like a lot of fun. Let's do it.
Oh, fantastic. All right. One of the things I forgot to mention too, listeners, I do apologize. This came out, Secure Act passed and whatnot, and I am on vacation actually in Hawaii. So there's a little bit of extra background noise here. So I apologize a little bit of the backdrop as well as the audio, but hopefully it'll be okay and we can jam through this. All right. Yeah. So Steven, I guess the first thing I would kick off is when the Secure Act was passed, what is the Secure Act 2 and why does it matter?
What is the Secure Act 2.0? We'll leave all of my pontificating to the side. The Secure Act 2.0 was a 4,000-page spending bill that was passed that included, depending on how you count, it included around 100 different rule changes specific to retirement. And so it's a lot of different things that have the potential, not just the potential, it will impact really every taxpayer at some point in their life. And I can confidently see every taxpayer at some point in their life because it changed rules around RMDs, as an example. It changed contribution limits. It did all sorts of things around Roth options. And so yes. It's this bill by Congress that it was right at the end of the year. I wouldn't call it a gift. I hope no one else will call it a gift. Just seems like, hey, here's one more chance to make this a little bit more confusing. But it's important to all of us just because of how all those nuances affect our planning decisions.
Yeah. Now, one of the things, whenever we're looking at law like this and we're starting to go through these tax act changes, there's a couple ways that I look at them is saying, number one, okay, what are they trying to do? And from a tax standpoint, from an investment standpoint, retiree standpoint. And then number two, what are the action items I need to bring to my clients? So that's the way that I'm going to focus looking at them. One of the ways I don't focus in looking at them, and it's the same thing when I'm talking to clients, is it says, well, why did Congress do A, B, and C? Well, and Steven, this is the problem with this administration. It's the same problem as the previous administration. They don't return my phone calls. Like, I got great ideas, I'm telling you. But anyways, so they don't take my advice on this type of stuff. So this is what it is. We're going to digest it from that standpoint, and we're going to take it from a retiree standpoint. So yes, it was in the Consolidation Appropriations Act, all of this other stuff. And a subset of that was the Secure Act. And one of the things that I'm going to say how this affects federal employees and why you need to listen is because this changes RMDs, and because this and right before this passed, there was more clarification on inherited IRAs that came out. And both of those things directly affect you as a federal employee. One of the things, Steve, I talk to all my clients about all of the time is their RMDs, their required minimum distributions. For those listeners that may not know, so the RMDs came out, and at first it was April 1st, the year you reached 70 and a half was the first rule, right? Then that got changed in Secure Act 1.0, and it pushed it to 72. And so you didn't have to take these distributions until 72 years young. And then at 72 years, and now it's Secure Act 2.0, now that got pushed up to 73, potentially 75, depending on how young or old you are. And so it's changed it yet again. So we have these multiple rules that are out there. So I want to go through how those work. And then RMDs, again, is a calculation the IRS gives us every year of how much is the minimum you have to take out from your tax-deferred accounts, not your tax-free accounts, Roth IRAs. Great news is there's no RMDs on those, but there is on your IRAs, on your TSP account. And Steven, let me know if you've ever run into this, but I run into clients that have done a great job in saving in their retirement accounts, maybe their TSPs, their IRAs, et cetera. They're growing that money. They have a fantastic pension. They have fantastic Social Security. They don't really need to take that money out, but then all of a sudden they have to take this RMDs. And I see two things happen. Number one, it bumps them to a higher tax bracket they weren't anticipating. And number two, it increases their Medicare premium. Do you see that too?
Yeah, all the time. Micah, there's one quick thing I want to throw out before we get too much further. And I think you've already covered this with a lot of the clients you work with. One of the things that I always immediately look for at a tax law changes, I like your focus on action. Is there any immediate response I need to go out and take care of right away, next week, next month? And the great news is, please push back on me if you saw this differently. There wasn't anything in Secure Act 2.0 that someone needs to rush out and change immediately. Certainly things we need to make sure we've addressed before the end of the year as we go through our planning cycle. But great news for all your listeners. If you're just learning a little bit more about Secure 2.0, don't rush out tomorrow and make a drastic change. Yeah, want to throw that out there. So coming back to RMDs, yeah, absolutely. Those are issues that come up. Of the name of the book, "Don't Get Killed on Taxes." That is a great way to get killed on taxes, is to wait until the last minute when the IRS is now forcing you to take these distributions. And as people hear, oh, I have longer before I have to start taking these distributions, I'm just going to push that off. I'm not going to do anything until that comes. That's a great way to get killed on taxes, because not only will your balance be bigger at that point, which means your required distribution will be bigger, pushing you into a higher tax bracket. Micah, you talk about this all the time. We already know that tax rates are going up in a couple of years, that's if Congress does nothing. So we're pushing off a bigger balance, or waiting until tax rates get higher if we just wait and let this happen to us by default.
Yeah, so that's a really important clarification. So we got to be proactive in our tax planning, right? That's why every year you should be looking about how much should I fund a Roth? How much should I do a Roth conversion? How much should I fund pre-tax? Now, we're not saying from this go and max fund your Roth IRA, but it may not be a bad idea. It could be something great to do. But every single year you have to be looking at this and being proactive in it. The other thing, as we start going through this, I want to talk about how the Secure Act is going to work with regards to these RMDs, these required minimum distributions, and run through a couple of examples. So one of the things that we talked about was that the Secure Act changed how RMDs work. And one of the things, Secure Act 1.0 says you don't have to take an RMD until you're 72 years young. And now that's changed. And so understanding, I'll let Steven jump in here and correct me if he reads it differently, is that if you already started taking your required minimum distributions, nothing has changed. If you were 72 last year or older and you were already taking your RMDs, you continue as scheduled. There is no adjustment. There's no exemption. You still have to take your RMDs. If you haven't started taking your RMDs last year, as in 2022, you were not 72, but in 2023, would be 72. You do not have to take RMDs for 2023. You don't, correction, I should say this better. You do not have to start your RMDs for 2023. So if you're already taking them, you still got to take them. If you haven't started and this was the year you had to start, you got bumped 1 year to 73. So in 2024, you would have to start the RMDs. Steven, does that make sense so far as we're working through that?
Yeah, and you're spot on, Mike. And there's a couple of really important things in there to reinforce, especially as I see how other people are talking about Secure 2.0. One of my least favorite headlines I'm seeing right now is no new RMDs in 2023, because I don't think it really hits the point on the head. Because I've talked to clients where they think, oh, a new RMD. Well, I took an RMD last year. That was last year's RMD. Now I need to take another RMD. So that's a new RMD.
That's right.
And absolutely, you need to take that new RMD. Or you mentioned inherited IRAs earlier. We can come back to that. There are situations where you need to take a new RMD this year. The other one would be in your first, you mentioned this earlier, Micah, in your first year, you have to take RMDs. You can wait until April 1st of the next year. So if you turned 72 last year and you said, you know what, I don't want to do it by the end of the calendar year, I'm going to wait till April 1st, you still have to take that RMD before April 1st if you turn 72 in 2022. But yes, we have this, we'll use very loose air quotes here, we have this gift of an extra year if you are turning, if you hadn't already started your RMDs previous to 2023.
All right, I'm starting to get tax nerdy. Sorry, warning out there. I need to have a sound effect warning for this. But one of the things that Steven, I heard you say, which is 100% correct, but we have to be really careful, and I know you know this, is you said if you were 72 last year and you elected to defer your RMD, because that is correct, you don't have to take it until April 1st the year following you turn 72. Well, let's say you did that. Steven, how many RMDs do you have to take this year? So last year you were 72. You chose to defer your RMD until 2023. How many do you have to take this year?
I feel like that's a trick question, Micah, because you could split it into multiple chunks and I could get it to as big as numbers I want. But to your point, yeah, we've got to make sure we address 2022 that we waited on, and then 2023 before 12/31, because we only get that election to defer until April 1st once. So yes, to your point, and I know this is the reason you're bringing this up. This gets missed all the time, that people think, let's just wait, and not recognizing, oh, perfect, now I've put two distributions into the same year.
I've been doing this for over 22 years, and I look at tax projections all the time, and Steven, I know you do as well. And in 99 times out of 100, it makes no sense to defer. Yes, there's the 1 in 100 case where somebody sold a property this year, or they're getting an inheritance, or something as big is happening this year, where it makes sense to defer and take two RMDs next year. But be really, really careful about that one, because you are the one that's responsible for making sure both RMDs get taken. The other thing that I start getting really cautious about, especially with new clients are coming in, is I really want to go backwards, especially if they're over their required beginning date, which means they've had to start their RMDs. If they're over the age to start the RMDs, I always want to go back and I want proof from the custodian that they satisfied their RMD for the previous year. Because let's take a client, and let's say we take on a new client who's 73 years old, and he goes, yeah, great news, I've already taken my RMD for this year. And okay, well, what does that mean? Does that mean that you took it for this year, satisfy last year? Does that mean you took, where are we at for this? So you always want to go back and verify this whenever you're moving accounts, whenever I'm working with a new client, et cetera. So for federal employees, I say a lot of caution here. 99 times out of 100, take the RMD in the year in which it's due. It would be really, really important. Other pro tip, I'm just going off on this. Sorry. Other pro tip, I'm going to say this with processing hundreds of RMDs with clients, is do not wait till the end of the year to do this. Custodians get backlogged. They just do, because everybody waits to the end of the year to do stuff. Then they go on holidays, right? Then they have breaks. And sometimes RMDs get missed because custodians don't get around to processing them in time. TSB, you could be really careful with that one as well, because you can only take one distribution within 30 days. So you got to make sure you're ahead of the game taking these distributions. All right. So sorry, we'll get a little tangent on that one. So we talked about RMDs when they went and started. We talked about, if they've already started, you got to keep them going. Steven, let's make a little bit of a transition and let's talk about these inherited IRAs, because when Secure Act 1.0 passed, it eliminated the stretch IRA for us, right? We used to be able to, God forbid, but if you passed away, you left your IRA to your kids, you could stretch that over your kids' entire lifetime. So instead of them having to take all the money out at once and be taxable, they could divide it by their life. I'm oversimplifying this, but they could divide it by their life expectancy, take a little bit out every single year. Then when Secure Act 1.0 passed, that went away and it turned to a 10-year rule. But the IRS has recently come out with guidance on what 10 years means.
Yeah, Micah, I'm laughing because you kicked all this off saying that, hey, when tax law changes, that they're not really final or official or clear, any of those things. And when 1.0 happened and it switched to this 10-year timeline, I guess the talking heads, the powers that be kind of looked at that and said, oh, well, this means there are no RMD requirements. That's clearly what the IRS meant. So we're just going to, we can plan it however we want across that 10 years, but it's up to us. And then the IRS came out later and said, no, you silly people. We absolutely meant there's an RMD requirement on top of that 10-year thing. And then everyone said, what does this even mean? COVID happened, and we had a couple of years where they said, well, let's just not worry about them at all. And now we're here to 2023, where they've clarified what they meant. And they said, okay, you need to go ahead and start taking care of that this year. Again, back to my point about the no new RMDs on inherited IRAs. For IRAs that were inherited in 2021 or 2022, you absolutely are going to have new RMDs in 2023.
Yeah, absolutely. So one of the things that I'm going to say to be very careful of with our clients, let's say that somebody, and we talked about this a little bit, warnings kind of on previous podcasts, but let's say you inherited an account, a loved one had passed away, and you inherited under Secure Act 1.0, which is in the last couple of years, and then you decided to defer your RMDs. So let's say you got this inheritance in 2020. There was no RMD requirements in 2020. They were waived because of COVID. And then you were saying, hey, I'm under a 10-year rule. I'm not going to take any money out of this account, and I'm going to take it out in a lump sum in the future. So you got the money in 2020. There was no RMD for 2020. That was waived. Then there was 2021, 2022. You did not take an RMD because you said, hey, I got 10 years to take this money out. Now the IRS has come back and said, no, you don't. You have 10 years to deplete the entire account, but every year you have to be taking money out of the account as an RMD. So Steven, for those two missed RMDs, because in this scenario, they are missed for 2021 and 2022, what happens? What does a client need to do?
Yeah, so the IRS, in true IRS fashion, came out with a notice to try to clarify this. And in that notice, there's a section that very specifically says guidance for, and they use some terminology, but it's basically guidance for people who didn't take those RMDs in 2021 and 2022. And it says in there, hey, we're going to waive the penalties if you didn't take those RMDs. And Micah, you and I both had kind of the same thought as we read that, where we said, okay, but wait, you're waiving the penalty, but do we need to go back and take the RMD or not? And at least at the point where we're recording this, that still hasn't been clarified. So for my opinion, my reading of this, that was the IRS's guidance on, okay, here's what you should do. And they left out any indication that you need to go back and take those RMDs. So as I'm working with clients on inherited IRAs, if they did not take those RMDs in 2021 and 2022, we're not going to go back and now make those up. We're going to start with 2023 and move forward.
But this is a little unclear. Just to be clear, it is unclear, right? This is money. We are making an educated guess that we think the IRS is determining, because the IRS is not clear on this. Is that a fair statement?
That is a fair statement. Is that the same approach you're going to take, Micah?
I'm going to ask my clients for their tax tolerances, right? Of saying, hey, we don't know. Deferring it is an option. The IRS could come back. What's the worst case scenario? The IRS comes back in 2 years and says, you should have taken those RMDs out. I'm now going to charge you a penalty. And maybe is it become an excess contribution after that with 6%? Or is it just the 10% penalty it's reduced to? Because that's another good thing with the Secure Act. They've reduced the required minimum distribution penalty from 50% down to what, 10%?
I think 25%. 25? They cut it in half. How generous.
The scale. It's so generous. Yeah. So yeah, it's getting reduced, which I love. So I'm telling clients, hey, worst case scenario, the IRS could come back, make you take the money out and pay the penalty, right? That is the worst case scenario. More than likely, you don't have to take it out. Mr. and Mrs. Client, as you lay your head on the pillow tonight, is this going to keep you up? If it is, take the money out, let's pay the taxes on it, move on with life. If it's not going to keep you up, okay, well then let's move forward with it, because it's our best guess. And sometimes we just have to interpret. We have to guess a little bit on what's going to happen. Good news is this is what a lot of financial advisors and CPAs are saying. So this isn't some rogue opinion out there.
Yeah. Yeah, because unfortunately, those clarifications can take months or even years. I mean, this example we're talking about, Secure 1.0, we're years past that now, and we're still trying to sort out these last details.
Yeah, very much so. Okay, so we talked about this. So what's another thing that this is going to apply? Well, one of the things that you have to be thinking about is for federal employees, what is your tax plan going to look like now? Now, the great news is, we talked about it before in this podcast, a great tax planning tip was be using a QCD, a qualified charitable distribution. This is when you reach 70 years young from an IRA. Nope, you can't do it from the TSP. It's not my rules, I promise. It's the TSP's limitations. So you can't do it from the TSP, but you can do it from an IRA. You can send money directly from an IRA account to a charity, and it's 100% tax-free transfer. Stephen, in fact, it doesn't even pop up as a taxable income on your tax return. So it doesn't matter if you itemize deductions or don't itemize deduct, you can still do that. Is that a correct statement?
That's a correct statement. And the other thing that it does for you by doing a qualified charitable distribution is it takes it out of our adjusted gross income. And that's really important for Medicare. You mentioned Medicare adjustments earlier. And so even if you do itemize, it's worthwhile to do these qualified charitable distributions, because now we're going further up the tax return and taking it out of the equation.
Now, and this is really important because a lot of clients, well, nobody really likes it when they get bumped into what we call a next IRMA bracket. IRMA is the income adjustment from Medicare. They do not line up dollar for dollar with tax brackets. So different tax brackets are different with IRMA, et cetera. So basically, I think, Stephen, you'll probably have these numbers better than me. It's around a married filing joint, $194,000. So roughly $194,000 is what they just came out with this last October. Is that about right?
That's about right, yeah.
Okay, so that's the number. Now, that's the number they set for 2 years ago, by the way. So what that means is we're guessing at what these numbers are going to be going forward. But when we're working on tax planning, and again, this is what I would really encourage my federal employees to do, I like my 10-year tax projections. I like to sit down when you retire, say the next 10 years, where's your income going to come from and how much are you going to pay in taxes? Now, why does 10 years matter? Well, 1 year at a time, you're kind of playing cat and mouse, right? You're playing checkers. 1 year at a time, saying, hey, what's one move I can do that kind of jumps the other opponent, beats the IRS out of a couple of dollars? But I'm not interested in beating the IRS out of a couple of dollars. I'm interested in legally beating the IRS out of tens of thousands of your dollars. And in order to do that, man, you got to look at the taxes from a longer term perspective. But Stephen, you do tax returns every single year. Do you agree with that? Do you disagree?
Oh, I wholeheartedly agree with you, Micah. Unfortunately, I think that's the exception for tax professionals, but wholeheartedly agree with you. And so earlier when we talked about just deferring your RMDs for an extra year to 73 or a little bit in the future all the way to 75, if we just let that happen, that's not an advantage. In fact, we're probably going to get killed on taxes. But if we're taking this 10-year approach and now we have an extra year, an extra couple of years to have an intentional plan, okay, now that can be a good thing for us because we're intentionally looking for those years where we would otherwise have relatively higher or lower income, and then making intentional decisions to say, yep, I'm going to bump my income in this year on purpose because I know that that's going to set me up over that 10 years to save on taxes over the long run.
Now, when we say taxes, IRMA is a part of that, right? And so if you are not working with a tax professional that is looking at the taxes in the next 10 years, you need to find someone who's going to help you with that. Maybe you got a great preparer. I'm not trying to dig on your preparer. Maybe they do a fantastic job, but maybe they're not the ones that are going to do the long-term tax projections for you. If you need to work with someone's going to do that, because man, we can just see mistakes after mistakes that happen when we're not playing the long game with the IRS.
Micah, how do you help your clients, or how do you empower your clients to vet that from a CPA? I mean, because that can be really hard to discern if someone's going to do more for me than just file a tax return.
Yeah, well, my clients, they hit the easy button. They hired us. And so we just do it. And so regardless of the CPA is going to help with that or not, we are going to make sure that we're doing tax planning with the client. Now, one of the our is to work with that CPA. So one of the things that I want to know is I want to know, has the CPA, when I'm working with a new one, do they look at taxes into the future? What do they think about upcoming tax law changes? What do they think the client should do in the next couple of years? And if the CPA, kind of my default answer, and there's always exceptions, but the default is that the CPA is in the mindset of defer, because in the future, their income will be less. That's generally a bad sign. Now, and I wish I could say I was joking about this, but it happened to me at the end of last year. I was working with a client CPA. It was a new relationship, and talk with them. And I want to do a Roth conversion, Steven. And the CPA was like, no, we should wait because their income is going to be less in the future. And I said, well, that's fantastic. Could you tell me what year will be less in the future? And there was silence. They're like, well, when they go to retire, their income is going to be less. And I said, well, hold on a second. I said, great news is they're a federal employee. They have a fantastic pension. One was under the old retirement system. One's under the new, plus Social Security. I said, really? Their income is not going to be less when they retire. Their taxable income is going to be darn near the same when they retire because of pension income, Social Security, et cetera. So when is their income going to be less? And he just kept saying, well, in the future it will be. It just will. That's just how it works. So when I start getting answers like that are just very vague rules of thumb, and someone can't distill it down to when they say their income is going to be less 1 year at a time. Okay, I'm dealing with somebody who's playing checkers in a chess game, and they may be a great preparer, but they're not looking at the long-term picture.
Yeah, that makes a ton of sense to me. And for your listeners who don't yet have the pleasure of working with you or working with a financial advisor who is taking the reins like that, just one question I would encourage you to consider asking your tax professional is, what can I expect from your team outside of tax filing season?
Great question.
Just so that you're hearing from them. And honestly, a lot of the responses you're going to get is, well, great news. We'll get back to you next year and let you know what we need for the next tax return. And that's going to be an instant sign to you that they might do a great job of filing your return. They're not doing anything planning related. And so that's a simple way to start learning some of that context without feeling like you're just digging right into their personal life.
Yeah, amen. All right, Steven, this podcast is all about action items for our listeners that they can take and implement. So as you're the guest, I'll put you on the spot. What's the first action items that our listeners should be able to take this week and be able to start implementing?
Yeah, I love that you're focused on action items. I'm going to go in the opposite direction and reinforce a non-action, which is you don't need to rush out and change anything tomorrow because of Secure 2.0. You need to have this somewhere on your radar for this year to make sure you've talked to someone about how Secure 2.0 impacts your plan, but it doesn't have to be tomorrow.
Correct. I'm going to say it needs to be in the next couple of months. And Stephen pushed back on this. If you say I'll deal with it later, later means 12/31, which means it's not going to happen. So this is the one that says, no, you got to have a plan that's out there. If you have inherited IRA, you got to have a plan. I mean, that's going to be a big one that does affect it. Yeah. So there's nothing you got to rush out right now, but don't use that as an excuse to never get around to it. I think it's fantastic. A selfish plug right here. I'm going to say, join us for a webinar. Tammy and I are going to have a webinar on March 1st, which is going to be fantastic. It's the first of a 4 to 5 part series, by the way. So make sure you join us on that, which will be great. And then, Steven, I'm going to say another action item for our listeners is to create this year. So maybe it's not a this week action, but create an income plan, a tax plan for the next 10 years. Even if you're not retired, know and understand how much you pay in taxes. Know and understand where your money should go to pre-tax to Roth. Should you be looking at conversions? How do HSAs come into the plan? This seems daunting. Start with where you're at right now. Start with your current tax return. What's going to change in the next 10 years? If you want to work with a professional, make sure a professional can do this next 10-year projection. If they can, if they don't know what it is, maybe they're not the one to work with. But that's definitely something you should be looking at this year. Steven, anything else on your end?
Nope. Micah, this sounds like a great action plan for all your listeners.
Awesome. Steven, thank you so much for joining us. I do enjoy nerding out with you on tax. If our listeners want to follow more about what you're doing, I know you have a great podcast with, I think, Benjamin Brandt that talks to taxpayers on tax planning. Where can our listeners get more information on that?
Yeah, the Retirement Tax Podcast, the least boring tax podcast you know.
Fantastic. Until next time, happy planning.
Happy planning.